So what we're going to talk about today is how to physically make the budget. So yesterday we talked about things that will impact a budget. Today we're going to actually physically make it. So there are two budgets that you need to know how to make. You need to be able to make a budgeted income statement and then also a cash budget. The cash budget is the harder one to do. It's got way more steps involved than the income statement. Okay. So a couple of things. So a budgeted income statement is essentially looking at projected revenues and expenses. A cash budget or operating budget looks at different assets, liabilities, essentially your payments, like your money in and your money out, but looking at it not just from revenues and expenses, but looking at it from assets, liabilities, and owner's equity. So income statement looks at just revenue and expenses. Cash budget looks at it more from assets, liabilities, and owner's equity. Okay. The budgets are important because it helps you manage your finances. It helps you manage where you think your company is going. And if you're looking at areas of growth versus areas of decay, and just kind of how you should be spending your money to keep your business healthy. Okay. So the first thing that we'll do, just a couple of notes here with this. So what are cash receipts? So a company must estimate cash receipts from all sources. So cash sales, so that is like revenue examples, like people who come in and purchase your. So when it says cash sales, it doesn't necessarily mean cash. It could mean like debit or credit. Cash means debit or Interac, right? It doesn't necessarily physically somebody handing you a $20 bill. Okay. So an estimate of projected sales for the period, usually approximately 10% of all sales, and then a collection of accounts receivable. So when you're looking at money into the company, you're looking at directly people that are giving you money for jobs provided, or people who are putting it on, for lack of a better word, they put it on a tab. Those are your accounts receivable, right? Accounts receivable are people that you have provided a service to, but they have not paid their bill yet, right? So they owe you money. Those are accounts receivable. Accounts payable, remember, those are the people that you owe money to. Because maybe you have a credit card with that company or whatever. So cash receipts is money coming in from cash sales as well as money coming in from people who owe you. Okay. Now, the cash receipts are not equal to the sales for the month. Some people don't pay their accounts receivable on time, and sometimes customers return items or get refunds. So for example, at Christmas time, your sales might be through the roof. But in January, your refunds are going to be through the roof because parents return the gift or kids return a gift or whatever, right? Because they didn't like it or it didn't fit or whatever. So it's not that January you did worse. It's just that a lot of those sales that you recorded in December, a lot of them get refunded in January. So understanding that helps you budget it so that you're not going to be short cash in January when you get all those refunds. Okay, cash payments. So this is money that you are paying out. So if you make a payment on an accounts payable, so if you like pay off part of your bill to Staples office supply, you've got a credit card there, you owe them $2,000, you make a $150 payment. You can't afford to pay the full $2,000 off, or you give them like a couple $100. Payments for expenses. So this would be like your monthly bills. This could be anything like that. It could also be payments for capital purchases. So making large cash purchases for equipment needed. So again, you might buy a new truck for your business. Unless you're doing really well, you're probably not going to pay the full price for that truck. You're probably going to put down a down payment and do the rest as monthly payments. Well, you still have to record that as an expense. You're just not recording the entire expense. So a budgeted income statement provides the company with an estimated net income based on historical performance. A cash budget provides the company with a projected estimate of cash paid and cash received. So we've got these two things happening. We've got an income statement and we've got a cash budget. The income statement is an approximation of net income. A cash budget is an approximation of cash on hand. Like how much cash do you think you're physically going to have in the business on a month-to-month basis? So I'll tell you right now, income statements are way easier to do than cash budgets. So we're going to spend most of our time talking about cash budgets, but we'll start with the income statement because it's easier. So all the way back to our little Gurpeat lawn care and snow removal, this is his income statement. So this is how much money he brought in revenue. So he brought in $46.75 in snow shoveling fees, and lawn care fees were $18.90. So he had a total revenue of $65.65. His total expenses, so he had a snowblower expense, truck expense, miscellaneous expense, and lawn care expense. Total expenses was $700. So for March 31st, he had a net income of $58.65. That was his income statement. What we're going to create is a budgeted income statement. Okay? And we're going to use these numbers. Now, the numbers change question to question. So the process we do here, guys, is the same, but the numbers you're going to be given in the question will change per business. Okay? So Gurpeat is going to predict that his sales, that his revenue is going to go up by 20%. And the reason why he's predicting that is because he's going to increase his advertising by $500, and the rest of his expenses he's going to increase by 5%. So in other words, he's going to put some money into his business to try and grow the business. This one for sure, by doing more advertising, he's hoping that will pay off with more jobs. And because he's going to be working harder, his truck expense is going to go up. Like maybe he's going to have to buy more gas. Snowblower, maybe he has to put more into maintenance of it to make sure it doesn't break down, that kind of thing. So what does the form look like? Okay, so this is what a budgeted income statement looks like. So same thing, we've got the company name and we've got the date. So this was his budget from last year, which I'm just giving you. Don't worry about where this came from. This is the actual. So this is what I just copied down off of his income statement. So these numbers here are off of here. Okay? So the actual numbers are the ones that I copied from here. Okay? So for the budget, we are going to use these numbers right here. Okay? So an increase of 20% means we're going to times by 1.2. An increase of 5% means we're going to times by 1.05. Okay, so essentially what I'm doing is I'm going 1 plus 20%. Here, 1 plus 5%. So 20% is 0.2, 5% is 0.05. Okay, and then this, we just have to add $500. Okay, so this is why we need to use calculators today. So the revenues, these are going to get times by 1.2. Which one was it? So increases advertising expense by 500, recorded under miscellaneous. So miscellaneous, we're going to add 500, and all the rest, we're going to times by 1.05. Okay? So 46.75 times by 1.2. So 56.10. $18.90 times 1.2, $22.68. Okay, 75 times 1.05, $78.75. Now remember, we're talking dollars and cents, so always round to 2 decimal places. 250. So, whoops. 262.50. So for this one, you're going to go 125 plus 500. So that's 625 because we're increasing that one by $500 and the rest are being increased by 5%. And then this one will be 262.50. Okay, so to figure out net income, remember we do this and we subtract that, right? Revenue minus expenses. So 5610 and 2268. So 5610 and 2268. So I got that 7878. My expenses are 7875, 262.50, 262.50, and 625. So I'm going to go 7878 minus the 1228.75. You get 6649.25. So 6649.25. So that is his budgeted net income. So this year he had 5865. Next year he's budgeting 6649. Okay, and again, the bulk of that is because he's hoping that that extra advertising expense will increase his revenues by 20%. Now again, this is just a budget, right? Whether or not he actually happens depends on, so next year, so in 2018, this gets shift to this. We'll have a new actual column, so we'll be able to compare this 6649 to what actually happens. And you're constantly, it's called a year by year, what is it? A year by year comparison. And most accounting softwares, if you go into accounting in college or university, most of them do a 5-year. So you would do actuals for the previous 5 years, and then you would budget for the 6th year. And it shows you trends. You can see how your income went up, it went down, your expenses are going through the roof this year, but they were really nothing the next year, right? Like it allows you to see those trends in your spending. That's a budgeted income statement, okay? So I just want you to understand that you're not always going to be doing 20%, 5%, and 500. This will change question by question, so you have to read each question to see what you're going to do, but the way you do it is you just fill in that last column. That's it, okay? But you do it based on the instructions that you're given. Okay, so that was the answer. It's exactly what I got. Okay, so cash budgets now. So that was the income statement budget. That's what this is called, the budgeted income statement. Now we're going to do the cash budget. Okay, so this is 6 steps. It's intense. It is a lot of paper flipping. A lot. Okay, so stay with me. We're going to do a few of these. Whether or not we get through all the examples today, whatever, because this is our last big concept of this module. The last lesson that we have to do is quite small. It's actually a really short concept. So this is our last big thing. Okay, so we got Gurpreet's lawn, snow removal. Here's all his assets. Here's his liabilities. Here's his capital. Now, this tax payable, we haven't talked about that since the last module. Remember GST on purchases, right? And GST on supplies? That's what this thing is. Okay, so a liability. So what it is that the government wants income tax from him, right? When you run a business, you have to pay the government income tax, just like you have to take income tax off of the salaries of your employees. This is the income tax he has to owe the government. That's why it's a liability, because it's money that he owes somebody else. Okay? So we've seen balance sheets all semester. Nothing surprising there. This is the cash budget sheet. So you are going to be given those headings. So you're given this. What you have to do is figure out these numbers. And it's not pleasant. Okay? but you don't have to come up with these headings. So the template has this, we just have to figure out what numbers go where. So we've essentially got to figure out how much cash are we starting with. We're going to add in any extra cash we're going to get, and we're going to minus off any accounts payable that we have to pay, any expenses we owe, anything else with cash that we might owe, and any other cash payments that we might owe. So we're going to bring it, so essentially all the cash coming in and all the cash going out. Okay? And notice there are 1, 2, 3, 4, 5, 6. 6 things. So we have to figure out 6 numbers. You do not have to have this memorized. You're going to be given this. What I want you to understand is that the percents will change with every question that you do. But where you look up the numbers and where you look up the information will stay the same every time. Okay? So the first thing we have to fill in is the beginning cash balance. So to do the beginning cash balance, we go to the balance sheet and we're going to add cash and petty cash. So we're going to go to balance sheet. We're going to add cash and petty cash. So 2450 plus 200 is 2650. Okay. Now, second thing, we're going to do our estimated cash sales. So we're going to go to the budget sheet. So the balance sheet and the budget sheet are different. This is the balance sheet. This is the budget sheet, right? This is the budget. This is the balance. Okay? So we're going to go to the budget sheet. We're going to look in the last column. And we're going to add up all the revenue and times it by 70% or 0.7. So we're going to go to the budget sheet. We're going to go to the last column. We're going to take our revenues and times it by 70%. Okay, so 5610 plus 2268. So 5610 plus 2268 times it by 0.7. So what that number represents is we think we're going to get about 70% of the same revenue for the next accounting cycle. So 55, 14, 60. Where am I at here? Okay. So 55, 14, 60. Next step, estimated collections on accounts receivable. So this is what we're thinking people are going to pay their bills, right? These are people that owe us money. So this is what we're going to estimate. We're going to go to the budget sheet again. We're going to look in the actual column this time. And we're going to add up all the revenue and times it by 30%. Okay. So we're going to go to the actual column. We're going to take our revenue and times it by 30%. Notice 70 and 30 add up to 100%. Okay, so 4675 and 1890 and times it by 30%. So 1969.5. Okay. Now we're going to follow what the table says, and it says total cash available. So we're going to take those 3 numbers and we're going to add them up. So 2650, 55, 14, 60, and 1969.50. we get $10,134.10. Put that in the second column. So 10,134.10. Okay. Okay. Now we're going to go on to expenses. Okay, so now we're going to do cash out. So estimated payments on accounts payable. So this is what we think we're going to be able to pay out, or in other words, pay off some of our debt. So this one changes with every company. So Gurpreet, he's going to give his parents $50 a month for the money that they lent him. He has to give his bank $170 a month for the loan payment. And he needs to pay off his tax payable in full. So tax payable, go to your balance sheet. Tax payable is $550. So we're going to go $50 a month times it by 12. Why am I timesing it by 12? Because there's 12 months in a year. I'm going to go $170 a month times by 12 plus the $550 because that's how much is tax payable. This is his tax payable bill. Okay, so 50 times 12. So 50 times 12, 170 times 12. Whoops. Oh. Oh. Oh, come on. What's going on here? 550. Okay, so 30/20. Okay. Oh, it's times 12, not 11. Hold on. I did that wrong. 50 times 12, 170 times 12, 550. 3190. Okay. So 3190 is here. Okay. I should be doing check marks every time I get one done. Number 5, almost there. Last fiscal period's unpaid expenses. So what do I still owe from before? So go to the budget sheet, look in the actual column, add up all the expenses, and times it by 20%. So go to the budgeted sheet, the actual column. So budget sheet, actual column. We're going to add up all the expenses and times it by 20%. Was it 20? Yes, 20%. Okay, whoops, that's not it. Okay, so 75, 250, 125, 250. Okay, so 75, 250, I've already forgotten the rest, 125 and 250. And times it by 20%. So he's saying he's going to pay 20% off of his old bills. He's not paying them off in full, he's paying 20%. He's trying to do debt repayment. Okay, so that's $140. So he's going to do, where am I at here? $140. Okay. Finally, estimated cash expenses. Go to the budget sheet. Go to the last column. Add up all the expenses and times it by 80%. So add up all the expenses and times it by 80%. So 78.75, 260, 250. 625, 260, 250, and times it by 80%. So $983. Okay, so total cash, put that in the other column. Okay, so 3190, 140, 983. So 3190, 140, and 983. So 4313. So estimated ending. So notice here it says add, and here it says deduct. Okay, so we're going to take this and minus that.
I've added that to your library.
Well done. So 10, 134, 10 minus 43, 13. And we get 58, 21, 10. So what does that number represent? That's what he thinks he will have cash on hand. Like, in other words, if he has like a separate savings account, like a cash account, that's what he's predicting he will have. So that step by step that we just did, this idea of timesing this and then timesing this and then adding up that, these percents will change with every question that you do, but where you look and find the information stays the same with every question that you do. Okay, so the percents change, and the reason why the percent's changing is what the owner thinks they can afford to pay off, or what the owner thinks his customers will bring in to him. Okay, so yeah, so 58, 21, 10, is that what we got? Yes. So again, first column total, first column total, and then subtract, double underline at the end. Okay, so if you go into accounting, okay, so if any of you are looking at post-secondary bookkeeping, that kind of thing, for the most part, you're going to be using software packages, whether it be QuickBooks or QuickTax or CloudTax or Microsoft Teams, whatever program the accounting firm uses or the college uses or the university uses. For the most part, this is automated. So I do my husband's books on the farm. I use QuickBooks. Um, I can't bring QuickBooks in to show you simply because I've got quite a knot here. Simply because it's firewalled. So I can't import our company's files onto the server here to show you. But there's a button that says company and financials. When I drag that down, it says there's a cash budget option. When I click on that, it takes all of my previous cash expenses, money in, money out, and it does this for me and spits me back that. Now, I didn't go to school to be an accountant. I went to school to be a math teacher. I had to do 13 math courses at university to get my math ed degree. Not a single one of those math classes is anything I teach at high school. It is all stuff well beyond the high school level. And it's like, well, why did you have to take it? Because I have a math degree. I was in there with people who wanted to be mathematicians. I was in the same classes with people who wanted to do research for a living. We all had to take the same classes. We just have different degrees out. So probably what's going to happen if you go into accounting or bookkeeping at the college or university, you're going to have to know how to do this manually. They're going to want to see that you know how to do it. And then when you actually get your job, you get to click a button. But the idea being is that if the computer ever went down, you could still do it manually. You would still know how to do it. Okay? So for me, I'm going to give you the step by step. Do this, add this, times this. You get the step by step. You don't have to have it memorized. That's the whole point here. So let's do one more, see how we're at, and then go from there. Okay? Okay, so Koch moving and storage. Okay? So let's do the income statement first. Okay, so the answer is already there. I just want to show you how we did it. So here's his income statement. His revenue was 10,000, or no, 100,000. The expenses were 10,000 and 5,500. So Mr. Koch, he wants to have an increase of 30% in his revenue, and he's going to increase his expenses by 5%. Now, maybe that's wishful thinking, but maybe he knows something, right? This is a moving. Maybe he knows that there's a big factory going up in town and a lot of people are going to be moving into the area to start new jobs. Or maybe a factory is closing in town and he knows a lot of people are going to be leaving. Maybe he lives in a university town and there's lots of students moving in and moving out, right? So he's predicting he's going to have a 30% increase in revenue and an increase of 5%. So again, an increase of 30% would be 1.3. An increase of 5% is 1.05. So the revenue gets times by 1.3. The expenses get times by 1.05. So what that will look like is, again, timesing by 1.3, timesing by 1.05. So these would be the answers that you should get out. And then again, revenue minus expenses. So 130,000 minus the 10,500 minus the 5775. So his net income was 115,500. He is hoping for next year to have a net income of 146,275. Now, the other reason why that you do these budget income statements is that you probably have bank loans, especially when you're running a business this large. So the bank wants to see your business growing and they want to see projected growth as well, because that determines whether or not they will keep lending you money. You have to remember, when you guys open up your own business, if you open up your own business and you have to get a bank loan, you have to sign away collateral. So collateral, you have to sign a document saying, hey, if I can't make my loan payments, you can seize my assets, sell them off to pay off what I owe you. When you own a business, you sign over your business. So when you get a loan for, let's say you need to buy a moving truck because you are an operating moving business, you have to sign a collateral statement saying, if I default on this loan, if I stop making payments, you can seize my business and take all my revenues to pay off that truck. And anything left over after the truck is paid off, we will give that cash back to you, but the business is dissolved. It's scary when you open a business. So even though we're farmers, we are farmers that are incorporated. So our farm is called Wheat Ridge Farms. We are a business. We have a GST number, we have sales, we have expenses, we pay our son's salary, we have to do workers' comp, unemployment, CPP, like we are our own business. My husband is president, I am vice, I strongly disagree, but that is how it is laid out. I make all the decisions anyway, it's all good. He's the muscle. But here's the thing, when we bought our new tractor last year, the collateral is the farm. So if we default on those payments, they come after the farm and they get to sell off anything they want to get their money. We have no say. Now, we're a big enough farm that we're not going to lose the farm, but we could lose our combine. They could be like, the combine's paid off, we're going to sell that to pay off the tractor that you owe us. And we would be defenseless to stop. And if you're like, well, that sucks, why did you sign that? It is a non-negotiable. Like when you sign it, you sign it. When we started out and we bought our first piece of land, we had to put our house up as collateral because that's all we had. So if we defaulted on the loan payments for the land, they took our house. Now that never happened because we still have our house, but that is scary. It's really scary, but at the same time, banks are businesses. They have to protect their bottom line because they are taking a risk on you. How they base that risk is right here. If you are projected to keep making money and to keep earning revenues, they are more likely to lend you money at a lower interest rate with less collateral. So now my husband just bought a new air drill last year. all we had to put up was a cash bond of $150,000. So we didn't have to put the farm up at all. We said, look, we have $150,000 sitting in this bank account as savings. If we default on this loan, you can have that. So we've gotten to ourselves to a point where our revenues, where we are secure in what we have, but it took us, we've been married for 25 years this year. It took us 25 years to get to this security point. So if you guys are entrepreneurs and you start your own business, it is scary to start because you have nothing beside you and the banks will hold your business. Okay. And now also what that means is because you have nothing, they will seize your personal assets. So when my husband and I started out, we didn't have any assets on the farm because we were starting out. So we had to sign away our personal vehicle. So my car that I use to come to work, that has nothing to do with the farm, they could have seized that. They could garner my teacher wages. So instead of me getting a paycheck every month, that paycheck goes to the bank. They're going to get their money regardless of how they do it. So when you are signing up for loans and you're starting your business, you have to be very careful. As long as you have a good accountant, which hopefully is you guys will give that business owner advice so that they do not borrow more than they can pay. When your accountant is giving you bad advice saying, oh yeah, take another loan, you can afford it, when you really can't, that's when businesses go bankrupt. And when you go bankrupt, there's a rule in Canada. If you go bankrupt, it is 7 years before you can borrow another dime. 7 years it screws you over for. And that's the law. That's nothing personal. That's just where we are legally in Canada. So things to keep in mind. Okay, so rant over. Okay, so budgeted income statement, straightforward. Okay, whatever it tells you to do in the question, that's what you do. Okay, tomorrow, come back to class. Tomorrow we will do one more cash budget together. Okay, so we'll do, here's the balance sheet, here's the income statement budget, and we will go through these steps, okay, and do a new cash budget, okay? So that's what we will do tomorrow. It will only take about 15 minutes to go through number 2 of this, okay? And then what we'll do is we'll get you set up in the lab to do the assignment on this. Then we've got one lesson left, and it's short. It's a little assignment. And then we're done the module. All you'll have left is the big project. But I have to talk you through that big project because it's like 12 different things you have to fill in. You're essentially going to take on the role of a bookkeeper and do the month end for that business. Okay, so it's going to take you a couple of weeks to get through all that information. But a couple of weeks takes us to the last week of May, which means you can have your 80% in 4 credits and you can have a spare for the month of June. Okay. Last thing to say